Gold bars are being pulled off planes mid-flight. Swiss refineries have frozen shipments. And in Washington, Trump just reversed his own tariff war to keep America's vaults from running dry. The U.S. debt clock already races past $37 trillion. Bond yields are spiking, and every investor from Beijing to Dubai is dumping dollars for gold. China now mines more bullion than the US and Canada combined, and its banks are buying up global supply with billions in fresh quotas. For the first time in decades, the world's most trusted safe haven is slipping out of America's control. While the White House quietly admits it cannot survive without imports from the very rival it tried to punish, the immediate cause is tariffs at levels unseen in over a century. According to the U.S. International Trade Commission, the average applied tariff rate now sits between 18 and 20%, the highest since the 1930s. A $100 imported item now costs Americans at least $120, and the difference flows directly into federal revenues. Scott Bessent, Trump's Treasury Undersecretary, defended the policy as a way to fund government priorities, but critics argue it functions as a broad consumption tax. Peter Navarro, a longtime White House trade advisor, insisted tariffs act like tax cuts, suggesting they recycle revenue into U.S. jobs and industries. Yet, economists across the political spectrum have countered that logic for years. The Congressional Budget Office reiterated in July 2025 that tariffs ultimately act as price hikes paid by consumers and businesses, not foreign governments. The divergence between official rhetoric and economic outcomes has only widened as data confirm collapsing demand and shrinking output. Trump himself has conceded ground by issuing selective exemptions. In June, the Commerce Department announced tariff suspensions on uranium, tungsten, graphite, and gold bullion. Each material serves as strategic sector: uranium for nuclear power plants, graphite for electric vehicle batteries, tungsten for aerospace components, and gold bullion for financial markets. Without these carve-outs, industry groups warned of immediate production halts. The Department of Energy's 2025 critical minerals report labeled uranium, cobalt, lithium, nickel, and graphite as extreme supply risk, underscoring the fragility of U.S. resource chains. Graphite illustrates the dilemma. Half of U.S. imports come from China, but in July, the administration imposed a 93.5% tariff on Chinese graphite exports. Prices spiked, and domestic battery manufacturers scrambled. According to Bloomberg, Toyota and TSMC executives privately warned Washington that supply chains would not relocate to the U.S. without stable access to minerals. By September, exemptions for non-Chinese graphite suppliers were pushed through, but the disruption had already slowed U.S. EV battery production. Zuckerberg sat before Congress in July, questioned on his company's plans for U.S. technology investment. He admitted Meta expected to spend $600 billion through 2028, a figure that sounded colossal, yet underscored Washington's reliance on private capital to fill supply gaps. The exchange reported by the Wall Street Journal showed both desperation and overconfidence. Silicon Valley is being pushed to retool, but without graphite, cobalt, and rare earths, even trillion-dollar firms cannot deliver. Then came the gold exemption, the most politically charged. In August, confusion broke out after U.S. Customs suggested tariffs might apply to imported 1-kilogram gold bars, disrupting shipments from Switzerland. Reuters reported that Swiss refiners halted exports until clarification arrived. Futures on the New York COMEX surged past $3,500 an ounce before falling back when the White House clarified tariffs would not apply. Trump later declared on social media that gold would remain exempt, sending bullion markets into volatile relief. The exemption raised questions: why prioritize gold over other industrial inputs? Analysts at Goldman Sachs suggested in August 2025 that Washington may be preparing for future gold-backed strategies as debt pressures mount. The U.S. national debt surpassed $37 trillion in August, 5 years ahead of schedule based on Congressional Budget Office forecasts. Debt is growing by more than $500 billion each month. By 2035, the CBO projects 60 trillion, and by 2048, 100 trillion. If current trends continue, the number could approach 150 trillion within 30 years. Bond markets reflect the anxiety. 10-year Treasury yields climbed to 4.5% in July, a level not seen in decades. Foreign buyers, once reliable, have been retreating. The IMF's July 2025 currency composition of official foreign exchange reserve survey showed the dollar share down to 56%, while the REM rose to 7%. These shifts suggest central banks are hedging, diversifying into gold and other assets. China's strategy is the clearest. The People's Bank of China announced in May it had expanded gold import quotas, allowing commercial banks to use dollars to buy bullion. The move, reported by Bloomberg, aimed to absorb dollar inflows while supporting the yuan. At the same time, Chinese companies have been acquiring gold mines worldwide. Zhun Mining raised over $3 billion in a Hong Kong IPO in July 2025. Funds earmarked for acquisitions in Central Asia and Africa. In 2024, Zhun acquired $1 billion gold mine in Kazakhstan, adding to its portfolio. China already produces more gold than any other country. The China Gold Association reported 380 tons mined domestically in 2023, more than the combined output of the US and Canada. Consumption is even higher. The World Gold Council reported in April 2025 that China's demand surpassed 900 tons in 2024, covering bullion, jewelry, and technology use. Imports bridge the gap. Over 500 tons flowed into China annually, primarily from Russia and Australia, and most stays there. The implications extend beyond bullion. BRICS members, including Russia, India, and Brazil, all contribute to a bloc that now controls both supply and demand. Russia's exports of gold to China surged after Western sanctions, and India has increased bullion purchases for reserves. This concentration of flows undermines Western markets like London and New York, which historically dominated gold liquidity. Meanwhile, the United States COMEX inventories ballooned. Data from CME Group in February 2025 showed vault holdings at 44.5 million ounces, equal to 5 years of U.S. consumption. Banks rerouted shipments from Dubai and Hong Kong to New York, exploiting premiums between futures and spot markets. The Financial Times reported premiums of $100 at the height of the August tariff scare, later narrowing to $20 once exemptions were confirmed. Deliveries worth over $80 billion entered U.S. warehouses between December and March, a record influx. This pattern reveals fragility. If tariffs were reapplied or clarified differently, flows could reverse, draining COMX inventories and leaving U.S. markets exposed. Futures spreads show the risk a sudden inversion could trigger an outflow as banks redeploy bullion elsewhere. Swiss refiners, dependent on U.S. policy clarity, now question whether Washington's decisions are strategy or improvisation. The political theater compounds uncertainty. Trump touts tariffs as leverage, while exemptions highlight desperation. Navarro frames tariffs as pro-worker, yet the Bureau of Labor Statistics confirms job losses accelerate. Besant insists revenues empower government, but Treasury data show deficits widen regardless. These contradictions raise the question: are tariffs tools of strength or signals of weakness? So China's approach appears steadier. By boosting gold imports and expanding mine ownership, Beijing positions itself to influence not just prices, but, global monetary structures as well. The IMF's July report hinted that reserve diversification may accelerate if gold becomes more concentrated under Chinese control. Western analysts debate whether this reflects a deliberate strategy to undermine the dollar or simply prudent hedging in these volatile times. At the end of the day, markets respond to actions, not intent. In August, Goldman Sachs raised its base case gold forecast to $4,000 an ounce by mid-2026, citing U.S. fiscal instability. In a stress scenario where deficits expand and Federal Reserve independence erodes, the bank projected $5,000 an ounce. With gold already up 35% this year, the path seems steep, but still plausible. Central banks themselves are accelerating the shift. The World Gold Council confirmed in July 2025 that official sector purchases exceeded 1,000 tons for the second consecutive year, the highest on record. Poland, Singapore, and Turkey all added to their reserves, but the largest buyer remained the People's Bank of China. Each ton absorbed by state institutions removed supply from open markets, tightening liquidity for private investors. At the same time, U.S. household demand for physical gold is climbing. The U.S. Mint reported sales of American Eagle gold coins in July 2025 reached 85,000 ounces, nearly double the same month a year earlier. Dealers in New York and Los Angeles described lines of retail buyers purchasing bullion as a hedge against inflation and political volatility. Corporate finance is also shifting. In June, Newmont, the largest American gold miner, announced it would price $1.5 billion in new debt against forward sales of gold at $3,200 an ounce, locking in historically high prices. Bloomberg noted this was the first large U.S. corporate debt issuance explicitly collateralized by bullion in decades. The consequences extend into trade corridors. Dubai's free zones reported record bullion transit volumes to Asia in the first half of 2025, up 42% from 2024. Analysts at the Financial Times observed that Chinese banks are underwriting these shipments, effectively using Gulf infrastructure as a bridge to funnel gold eastward, with official purchases soaring. Household buying surging and corporations securitizing bullion. The line between commodity and currency continues to blur. The question is no longer whether gold is back, but whether it ever left. Every development feeds back into the same crisis loop. U.S. tariffs choke industries' exemptions highlight vulnerability. Debt surges and gold becomes both hedge and battleground. Each statistic points in the same direction: reliance on imports, exposure to rivals, and fragility in fiscal management. And yet, the system continues. Month by month, jobs are lost, shipments rerouted, inventories stockpiled, debts expanded. No single decision collapses the system, but every decision weakens it. The pattern invites a sobering question. If gold is exempt today, what happens tomorrow when exemptions are not enough? China will keep buying mines. The U.S. will keep adding debt. Markets will keep recalibrating. And inside that swirl, a single bar of gold sliding through customs becomes more than a commodity. It becomes a referendum on power itself. We're glad you're enjoying this video. Please like and subscribe.